Welcome back. This is episode 194. In this video, I'm going to discuss whether or not it's time to start getting out of money market funds if you've been moving your money into money market funds due to the upcoming possibility that the Federal Reserve might be cutting interest rates. Welcome back. This is episode 194. As we get closer to the Federal Reserve doing their first interest rate cut since aggressively raising interest rates in March of 2022, I want to discuss whether or not you should consider selling some of your money market funds and short-term bond funds and going into other bond investments that could benefit from decreasing interest rates. But before we get into that, as a reminder, if you are serious about getting a plan in place for your retirement, consider signing up for my online retirement readiness course, retirement planning course, Retirement Readiness Review. It's an on-demand course where I educate you on what you need to know about planning the ideal retirement. I cover taxes, Social Security, Medicare, investing, estate planning, and much more. To learn more, head over to retirewithryan.com and click on courses. Now, I'm recording this on March 20th, and the Federal Reserve met earlier today, and they were discussing monetary policy in the United States and whether or not they were going to raise interest rates, or lower them for that matter. And they've announced that they're not going to be making a change to interest rates at this meeting. Now, going into this meeting, it was believed that that would be the case. And many experts believe that it probably won't be until the meeting in June, I believe June 12th, where there's a possibility that the Federal Reserve might be lowering interest rates. So if you remember, I've been recommending that you move money from your bank or other low-yielding accounts that aren't paying much interest into money market funds for the last year and a half, because as the Federal Reserve started to raise interest rates, the yields on money market funds began to come up. And you can now currently earn about 5% on your money market funds depending on where you keep your money. So with my firm, we custody our clients' money with Charles Schwab, and they offer a number of money market funds, but the one we primarily use is called the Schwab Value Advantage Money Market Fund. The symbol is SWVXX. And as of recording this podcast on March 20th, its current yield is 5.18%, and it carries an annual expense ratio of 0.34%. So that means if you hold it for a year, Schwab would collect a fee of 0.34%. Now, money market funds should definitely be considered part of your overall allocation. And I've talked about asset allocation before, so I'll put a link to some other episodes that you can check out. But you really should look at your money in different buckets. And you should have some money in risky buckets to be able to grow your money to keep pace against inflation, and that would be investing in things like stocks, stock funds, commodities, commodity funds, real estate investment trusts, real estate, or high-yield corporate bonds. And then the other bucket would be your safe money, and that's where you would keep cash, money market funds, government bonds, government bond funds, and very high-quality short-term corporate bonds. So money market should definitely be looked at in the context of where it fits into your overall portfolio, so as that mostly in your risky or safe money. So why money market funds? Well, as I mentioned before, it's a good place to put your money to earn more than your bank is probably paying you. They're relatively low risk, and they also have liquidity, meaning with money market funds, they trade for a dollar value. And the dollar value usually never changes in the money market fund. So what does change is the interest that the funds pay. And that interest on most money market funds resets possibly every 7 days. So if the Federal Reserve were to change interest rates, increase them or lower them, that would change your money market fund. So why might you want to move out of your money market fund? Well, as I mentioned before, this money market fund, the purpose of it is to help you earn more interest on part of your safe money. And you'd really want to choose whatever was going to give you the best rate possible. And the rate that you get on this safe money is dependent upon something called duration. And that is the length of time that you're investing your money. If you look at the yield curve, for example, and if you look at the Treasury yield curve, the yield curve is currently in an inverted position. And what that means is that you're earning more interest by having your money in shorter term investments, shorter term treasuries, than you would by going out and buying longer term treasuries. Normally what happens is that you earn more interest when you buy longer term investments. So the reason this yield curve is inverted is because we had such a steep raise in interest rates, and it was believed that rates would keep going up. So because of this, more people were concentrating on buying shorter term investments and really staying out of longer term investments. Eventually, the yield curve will go the other way, and it will go back to being where you're going to receive more interest by buying longer term investments. And when that happens, this is when you'd maybe want to consider getting out of your money market funds or reducing the amount of money that you have in them and earning more interest. Now, up until the Federal Reserve started raising interest rates in March of 2022, money market funds were paying almost nothing. And as the Federal Reserve began to raise interest rates, the interest that these funds began to pay also increased. Because what money market funds are is they're predominantly invested in short-term U.S. government bonds. So as the rates on these short-term U.S. government bonds began to go up, that also meant that the interest these money market funds would be able to pay would also go up. So what might make the money market rates fall? Well, the primary driver of that would be inflation. And in the U.S., our Federal Reserve is monitoring inflation to see what inflation is doing so they can make a decision about what to do with interest rates. And inflation has been high over the last year and a half, and it's definitely come down. And we can measure inflation by a couple different ways. One way is the Consumer Price Index. Another way that the Fed is looking at is something called the PCE, which is a measurement of personal consumption expenditures, which is a measure of the spending on goods and services by people in the U.S. And the Federal Reserve has said that they're focused more heavily on this than CPI. So if the Federal Reserve believes that this measure of inflation is going to lessen, they might start to cut interest rates. Because as we know, due to COVID, there's a lot of stimulus that was put into our economy, and this is one of the things that's keeping inflation so high because everybody has a lot more money than they did in COVID for the most part, and this extra money in the economy is really causing the price of goods and services to stay high. So the Federal Reserve doesn't want to cut rates too quickly because if they did, they could trigger even more inflation. Because by having rates go lower, that means that you're paying less to borrow money, or corporations are paying less to borrow, which would free up cash flow. Now, the benefit you're getting as a saver is you're getting more interest on your money market while rates are higher, but the negative as a borrower, if you have any type of mortgages you're taking out or car loans or credit card debt, you're paying higher interest. So as I said before, most experts agree we're probably not going to see the first rate cut by the Federal Reserve until the June 12th meeting. So what might this do to money market funds? Well, as I said before, money market funds are short-term bonds, and as rates are cut, that will mean that the yields on these money market funds will go down. Will they go down overnight? Definitely not. If the Federal Reserve raises or lowers rates slowly, maybe in a slower pace than they raise them, over time you would see your money market yields begin to decline. The value of the fund wouldn't go down, but the monthly interest that you're receiving would go down. So what might you want to buy to take the place of money market funds? Well, it would be another safe investment if this was your safe, bucket of money that we're talking about. So that would mean you'd be adding more duration risk to your portfolio. So what is duration risk? That means you're buying longer term bonds. So if you started buying longer term bonds or longer term bond funds, this would actually, in the short term, might earn you less interest because, as we've talked about, there's an inverted yield curve. You're getting less interest right now if you buy a 1-year treasury versus, a 3-month treasury, but it would give you the benefit of locking in what you're getting. If rates do go down, you'll be locked in for longer. So you could buy even longer term treasury bonds, for example, or government or corporate bonds. You also could buy bond funds. If you don't want to get into buying bonds themselves, you could buy a bond fund. So an example of that would be something like SPAB. SPAB is a core bond fund from State Street that's designed to track the Barclays Aggregate Index, which is a measurement of the bond markets in the U.S. And it has a yield right now of 4.5%. So you'd be getting less interest on that than a treasury or a money market fund, but it has a duration of 6.19%. which means that for every 1% decrease in interest rates, that fund will go up by 6.19%. The opposite would happen if rates actually continued to go up. You could lose 6.19%. For example, in 2022, as there was a tremendous increase in interest rates, I believe 8 raises by the Federal Reserve, this fund lost 13%. If you want to take on even more duration, you could buy something like SPTL, which is also a State Street fund. It's a State Street long-term treasury fund, and that has a duration of 15.28%. So that means if rates are cut by 1% into the future, you'll gain about roughly 15%. It also has a yield of about 4.5%, and in 2022 it lost 30% because it has a much larger duration. So when rates are cut, you could benefit by having a longer duration because you'd not only get interest during that time frame, but you'd also possibly benefit from an increase in the value of your bond fund as well. So that is something you could consider doing in your portfolio. Or you could also buy single bonds, as we talked about. If you don't like volatility and you are worried more about interest rates going up, then you could buy an even shorter term bond fund. But the point is that eventually money market rates will start to fall. And as rates come down, you'll want to do something to benefit from that decrease in interest rates and also be able to benefit from higher interest that you can receive. So am I going to do this right now? Well, I'm starting to dip my toe in the water and I'm buying a little bit of duration with these funds. But there's probably going to be some time until the Federal Reserve starts to cut rates, as we talked about, and they're probably not going to do it all at once. So depending on your objectives, you might want to do this slowly, or you might want to wait and see what the Federal Reserve does. So I hope this is helpful on how you may want to start reducing some of the exposure you have in money market funds. And if you have a listener question, I'd be happy to consider it for a future episode. Head over to retirewithryan.com and click on Ask a Question. Have a great week, and I look forward to talking with you next Wednesday. Take care.